Hi. Let's learn about the basics of cost basis. Cost basis is the original value of an asset for tax purposes, usually the purchase price, adjusted for stock splits, dividends, and return of capital distributions. This value is used to determine the capital gain, which is equal to the difference between the asset's cost basis and the current market value. The term can also be used to describe the difference between the cash price and the futures price of a given commodity. At the most basic level, the cost basis of an investment is the total amount originally invested, plus any commissions or fees involved in the purchase. This can either be described in terms of the dollar amount of the investment, or the effective per share price paid for the investment. Using the correct cost basis, also referred to as the tax basis, is important especially if you reinvested dividends and capital gains distributions instead of taking the earnings in cash. Reinvesting distributions increases the tax basis of your investment, which you must account for to report a lower capital gain and therefore pay less tax. If you don't use the higher tax basis, you could end up paying taxes twice on the reinvested distributions. Determining the correct cost basis is also the first step when calculating gains and losses after a stock is sold. For example, if 100 shares of a stock were purchased for $1,000 last year, with the first year of dividends amounting to $100 and second year dividends amounting to $200, all of which were reinvested, applicable tax law considers these reinvested earnings to be income. For tax calculation purposes, the adjusted cost basis when the stock is sold will be recorded at $1,300 instead of the original purchase price of $1,000. Thus, if the sale price is $1,500, the taxable gain would only be $200 instead of $500, $1,500 to $1,000. If the cost basis is incorrectly recorded as $1,000, this results in a higher tax liability than would normally be due. Cost basis comparison can be an important consideration. Suppose the investor then sells 1,000 shares of the fund at $19. The investor would have a capital gain of $5,670 using the average cost basis method. Results can vary significantly by cost basis. In this case, the investor would be better off if they had selected the FIFO method or the high-cost method to determine the cost basis prior to selling the shares. These methods would result in no tax on a loss of $1,000. With the average cost basis method, the investor must pay a capital gains tax on the gain of $5,670. If the company splits its shares, this will affect your cost basis per share, but not the actual value of the original investment or the current investment. Continuing with the above example, suppose the company issues a 2:1 stock split where one old share gets you 2 new shares. You can calculate your cost basis per share in 2 ways. In the event the shares were given to you as a gift, your cost basis is the cost basis of the original holder who gave you the gift. If the shares were given to you as an inheritance, the cost basis of the shares for you as the inheritor is the current market price of the shares on the date of the original owner's death. There are many factors that will affect your cost basis and eventually your taxes when you decide to sell. If your true cost basis is unclear, please consult a financial advisor, accountant, or tax lawyer. In regards to futures, the cost basis is the difference between a commodity's local spot price and its associated futures price. For example, if a particular corn futures contract happens to be trading at $3.50, while the current market price of the commodity today is $3.10, there is a 40-cent cost basis. If the reverse were true, with the future contract trading at $3.10 and the spot price being $3.50, the cost basis would be negative 40 cents, as a cost basis can be positive or negative depending on the prices involved. Cost basis is the original cost of obtaining an asset. It can include the purchase price and any fees. During the time an asset is held, its value can change, due to changes in market value, as well as any depreciation. The tax basis is the adjusted cost basis of the asset at the time the asset is sold. Capital gains tax will be charged on the difference between the sale price and the cost basis. Cost basis is important because it is how capital gains taxes are charged. If you sell an asset for more than the cost basis, you will incur taxes on the profit. If you sell an asset for less than the cost basis, you will incur a loss and not incur any taxes. This loss can also be used to offset taxes on other capital gains. In real estate transactions, the IRS can verify the cost basis by looking at the closing statement of when the property was purchased, or any other legal documents associated with the property, such as tax statements. The cost basis, usually the purchase price of an asset, is used to determine how much an investor will pay in capital gains. The larger the difference between the cost basis and the sale price, the larger the tax bill will be, monetarily. If there are a lot of aspects to the cost basis, such as fees, if the cost basis is adjusted due to dividends or stock splits, or if distributions are reinvested, determining the capital gain can be complicated. It can be helpful to use a tax advisor in these scenarios. Here are 3 key takeaways. 1. Cost basis is the original price that an asset was acquired for tax purposes. 2. Capital gains are computed by calculating the difference from the sale price to the cost basis. 3. Several accounting methods exist to adjust the cost basis so that it is more favorable, but be careful to follow IRS guidelines. Hope this would help. Thanks for watching.